This is Jim from Leftfield Investors. And in this episode of the Note Closers Show, Scott and I talk about passive investing, syndications, and the value of community.
This is the Note Closers Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closure Show. As always, Scott Carson, excited to be here with you today. I've got a very special guest joining us on here today, out of left field. You'll understand that here in a second, but he's an amazing guy. He's a former financial advisor. You'll hear me picking his brain about that. But he's a former financial advisor who really became frustrated with the path that most financial advisors take and the one path fits all approach to the standard financial services industry. He now concentrates on investing in real estate assets that produce cash flow and is committed to sharing his knowledge with others who are interested in learning a different way to grow wealth out there in today's world. So we're honored to have our buddy Jim Pfeifer joining us today on the Note Closure Show. Did I pronounce that correctly, Jim? I believe I did.
Yeah, you did. You nailed it. It's not most people get it wrong, but I appreciate you got it right.
Well, here in Austin, Texas, we have a community not next to Austin called Pflugerville. And it's the German aspect of it. So it's always the P and the F. Always come out as F mostly. Yeah. But, one of the things I love doing is listening to other people's podcasts. I was like, I want to make sure I get the name right for the most part, because it can sound differently coming out in just audio aspect of things. You know what I mean?
Certainly. Yeah, I appreciate that.
So, Jim, how'd you get as an ex-financial advisor, I always find it interesting talking to other financial advisors or past financial advisors, how I hate to say this, but they got rid of the brainwashing that happens in a lot of banks and institutions and saw the light. Did somebody show up with two pills and say, take the red one?
Yeah, that's pretty much it. It's funny. I've been a stock market, a mutual fund guy, stocks, all that for 30 years. And when I got into financial advising, it was my third career, really. I learned a lot about money that I thought I understood before, but I didn't. And at the same time, I had become an accidental landlord. We had built a house and we couldn't sell our old one. It was in 2008, so we ended up renting it out. And the combination, I think, of really getting educated at my financial advising job, they did a great job of training, and they're teaching us about how money works.
Right.
And then I was doing this real estate on the side, and it all kind of clicked. And I thought, you know what? Yeah, I understand what you're teaching me about financial products and finance, but it's all pointing away from the products we're actually selling. Uh-huh. And, so I had a little bit of conflict there, because I always prided myself, and I was not going to put someone in a financial product that I wasn't investing in myself. Mm. So I started investing in all the things that I was putting my clients in. And then as I got more and more involved in real estate, I found that I couldn't do that because, one, I wasn't licensed, so I couldn't really offer that advice. Two, I wasn't paid for it. But again, if I was putting my money in real estate, that's what I wanted to recommend. And so that kind of facilitated my exit of the financial advising industry. But it really opened my eyes to what's out there. And it's funny, because that's the way the name of my group, Leftfield Investors, came about, is because all my old colleagues in the financial advising world, they look at me like I'm in left field because I'm investing in these alternative assets. And, the alternative assets, it's where you live, it's where you go to work, it's where you shop, it's real estate, right? It's not alternative, but that's how they look at it. And so they look at me as I'm in left field.
That crazy guy, I think a lot of people, my background in finance and the financial advisor and the license, it was great. It helped me get to where I'm at today. But ultimately, when you start looking at how banking and the finance industry, it's a rigged game. It's honestly, in a lot of cases, a rigged game for the companies to succeed, but not necessarily the investors, right?
Absolutely. Yeah. And that's, you don't really realize that, but depends on where you work, what firm you're with, they're going to educate you on the products that they sell. And so you're going to become an advocate for those products because you're learning and they're telling you, hey, these are great products. And they teach you about them and man, they look great. And sometimes they are, if you put them in the right place and with the right person,
Right.
there are great financial products out there. But the bottom line is Wall Street constantly invents new products to get people into, and shocker, they're not always appropriate for everybody. And there's better ways to do things. And what I've found is, one of the biggest obstacles to wealth building is taxes.
Mhm.
And almost none of the financial products that financial advisors put out there, almost none of them are tax efficient, right? And real estate, I mean, the tax code is written for us to pay no taxes in real estate. So there's some disconnects there in the financial industry. And, I don't want to go down the whole of, everybody who's a financial advisor is trying to cheat you out of your money, because they are not. There are some great people doing it.
Right.
Some of them, they don't know what they don't know. And the others, they're taught what they're supposed to sell, and they do what they're taught, so I don't blame them. But yeah, it did take something else for me to get out of it, which is being into real estate on the side. And then that became all that I was doing. And that's when I had to leave financial advising.
So the question I like getting at too is that you said that you were trying to sell your house there in Columbus. I think I'd heard somewhere in a previous podcast you were originally from Alaska and bounced around and finally settled in the Buckeye State. Is that
Yes, sir.
And so having been forced so you got into real estate forcefully. You couldn't sell your house. Do you look back at that being such a pivotal moment in the hey, I had to learn how to become a landlord, or how to learn how to be to rent my property and solve that aspect?
Yeah, absolutely. And I hated it. I did it for 5 years and I hated it. I mean, it's the classic story, right? Christmas Eve, the bathtub breaks or something, and the guy's calling me, hey, can you come over to the house and fix it? I don't know how to fix a bathtub. So I'm Googling it and, looking on YouTube, trying to fix it while my family's waiting for me. I hated it. So as soon as the market turned, I went to my realtor and I said, sell this thing for me. And he said, well, hey, you know what? I also manage rentals. So why don't I manage the rental for you? And he knew I had the house paid off. And he said, how about this? Get a loan on it and we'll get you 2 more rentals. So I went from one asset, that was the return on equity in your home, if it's paid off, is 0, right? You don't get any return on that. And he got me into 2 more. So now I have 3 cash flowing assets, all with the same cash. And that's when like light bulbs started going off and rockets flying. I'm like, oh my gosh, this is awesome. And so I had 3 single family homes. And my immediate thought was, well, a single family home makes a lot of money. Now I need to get multifamily homes. And so I went down that path and started buying multifamilies and got a little bit carried away. But it just kind of, I got the bug right then.
Now, there's 2 things here. One, about the leverage of the equity. So many people, hey, let's pay off our house. I was dealing with an investor the other day. He's like, oh, I've got a house. I've got 7 properties completely paid off and I don't have any money to invest. And I'm like, you've got all this equity there saving you what? 3%, 4% if you were to get a mortgage these days. Down there when you could go out and make double that at least in some sort of passive investment, right? Right, Jim?
Yeah, absolutely. I mean, that guy he's not saving 3%. He's losing, right? Every time you have the equity in your home, it returns 0. Because think about it. If you have a house worth $100,000 and it appreciates to $150,000, it doesn't matter if you had 0 loan on it or a 75% loan on it. You still increase the value 50% or 50 grand, and all of it goes in your pocket. But if you had leverage on it, now you can take 75 grand out of there and go invest somewhere else, and you may be paying 3 or 4% on your mortgage, but you're making 8% on your investment.
Yes.
It's just dead money sitting there in a house. And once I realized that, everything opened up, because you don't want to be deep into debt, but if your debt is covered by other investments, other real estate, it's a no-brainer to take a mortgage out, or better yet, get a HELOC if your house is fully paid off, and invest that money, and it will just multiply. It's, if you use leverage in the stock market, it's dangerous because you can get out over your skis and have serious problems. But if you use safe leverage in real estate, it amplifies all of your returns.
Mm-hmm. Yes, it does. We are speaking the same language, mi amigo.
Yeah, yes, we are.
Now, you mentioned you going a little haywire, went a little crazy with the real estate bug and going on the multifamily side. Tell us about that journey.
Well, I did a couple things at once, right? I've heard flipping is the way to make money. So I went and did a flip. And man, I will tell you, we made hundreds of dollars on that flip, which, not good. 9 months, $100. That's how, and so I learned something. It was an expensive education, and I'm not flipping. That's not my strength. At the same time, again, I looked at one unit and thought, making money, let's go to multifamily. And so I met a guy, a property manager / realtor, and I was looking for a 4-unit, and he took me to a 22-unit. And, I ended up kind of going down the path where he said, just put an offer in. You don't have to, you can back out of it. They have curb offers. And I learned some stuff. He said, if you don't like the color of the paint, you can get out of the contract. And I just kept going down the line. And eventually I bought it. And so I bought a 22-unit, and I didn't know what I was doing. I did not manage it properly. The property manager didn't do a good job. I didn't do a good job. It was horrible. But at the end of after 3 years, the market had increased so much that it didn't matter. The market saved me. And, I more than doubled my equity on that deal, mismanaging it. And this is another way that I think real estate is it's the place to be. A good buddy of mine he ran a business that basically flipped homes. Then he was starting to get into multifamily. He looked at the deal and he wanted to buy it from me. And so I doubled my equity in 3 years. He bought it from me because I didn't want to, I understood now how to manage this property properly. I had to just restart, but I didn't have the energy and I didn't have the people to do it. So I sold it to him, and he doubled the value again in the next year and a half. And I was completely happy for him. I made my money. He made his money, and it was a win-win for everybody. And so that's what I like about real estate is I can mess up and still make money, sell it to another guy who does it right. And then he makes a killing and we're all happy. And so it was at that point where I started to think, I don't really like the active investing because I was trying to be passive and active at the same time. And I ended up managing the property manager and my multifamily homes. I also had some single family turnkeys that I was getting into in multiple markets, and every single one of them, except for the original houses I bought in Ohio, that property manager is awesome. All the rest of my property managers, I had to replace them. It was a struggle. I was managing the manager. And then I stumbled into passive investing through syndications. And at first I thought I want to be a syndicator. And then when I got more into it, I was like, nope, I want to be passive. And that's where I am now. That's where I've landed. That's what I love doing. That's where I'm making the money. And you know what? I don't have to manage managers anymore because I wasn't good at it. And to be honest, the people I was dealing with, they weren't good at property managing either.
So that brings the question: what have you developed as a checklist in identifying a good syndicator? Because there's a lot. I mean, my email's filled full of them on a monthly, weekly basis. Like a lot of other people, if anybody's data, oh, hey, we've got this. How are you? What have you done to develop your? Let's see if they pass muster kind of inspection.
Yeah, well, I'll tell you. When I started out, I went to a seminar with a pocket full of cash on a self-directed IRA. And as soon as I met someone, I wrote them a check. And that's the way not to do it. Right? I did not know what I was doing, but I was so excited. And I had this kind of use it later money, right? Because it's not money I need now. It's money I need when I retire. So I thought I can kind of experiment with this. Bad way to do it. Since then, I have learned a lot. And there are some pretty good syndicators out there. There's some pretty good podcasters out there. And there's also some podcasters who are really good marketers, but aren't good syndicators. And there's some that are both. So you really have to sift through it all. Where do you find them? And I've settled now, after a few years of doing this, I've settled on, I really am not interested in general in investing with a sponsor unless they come to me referred by someone that I know, like, and trust who has already invested with them. Now, there's exceptions, but that's my general rule because that's a great first step. And then there's a number of things I do to test the sponsor and make sure they're a fit for me is communication, right? That is the key because these are long-term illiquid investments. I can't get out of it once I've invested. And I have no idea how it's going to go for 5 years, right? These are long-term investments. So what I do is I communicate with them. I send them a couple of emails and see, are they going to respond in a timely fashion? And they're going to give me a quality response. And so, for example, when they send me a deal to look at, we have at Leftfield Investors, we have a deal analyzer. So we kind of throw some metrics in an Excel spreadsheet, pops up red if it's bad, green if it's good. So I take all the red, boxes. It doesn't mean don't invest. It means ask a question. I come up with an email. I write it up. I send it to the syndicator. And this is a test. I need a response either quickly or a reason why. And then I want a quality response. I don't want someone that says, hey, we just did the webinar, go check that out. I want you to answer my questions.
Right.
And then I'm a pain in the butt for syndicators because I have a lot of questions. So almost every time when they respond with those answers, even if I don't have another question, I'm going to fire off another question because I want to see, are they going to say, oh my gosh, this guy, and not want to answer it? Or as I had one syndicator, he emailed me, said, hey, can we get on a phone call? I'd love to talk about this some more. And so he dove into it. And that's the kind of person I want to invest with. So all along the way, you're kind of giving them tests to make sure, because the only investments that I'm not satisfied with right now are the early ones I made with people that do not respond to me. So I don't know how my investment's doing. If you communicate with me, even if the investment's going poorly, like I had a guy today communicate with me, the investment isn't going very well, but he was explaining himself. He was saying what happened. That's fine. I might invest with that guy again if it all works out and he, figures things out, because he is trying to let me know, hey, here's how it's going. But there's another one that, they say they haven't communicated or paid anything to me in 2 years. I'm not investing with those guys ever again, even though they say that they're going to, give me double-digit returns. I don't care, because I'm stressing about it the whole way through and it's not worth it. So for me, the sponsor is really the most important part of this process. The deal matters, obviously. The market matters, yes. But if you don't have a good operator, then you're just back to where I was managing poor property managers, right? I am not interested in that. I want to deal with someone that's quality. The other thing I look for, and again, there's exceptions to this as well, is I want someone who has some experience. And I prefer someone who's, been through a cycle or two, like before 2008, but those are hard to find.
Right.
So, there's plenty of people that haven't had that experience that I invest with, but I try to, you got to have at least a few exits. I don't want you to experiment on me. I want to deal with you after that, but I'm also open to people that are new, as long as they're going about it the right way. And I may take a few shots with someone new.
Well, that's the thing. Syndication is usually, I get people all the time like, hey, I want to raise $5 million and do big. Like, great, go do some deals first. Go do those $50,000, $100,000 deals. Get your systems in place. Get your communications in place. Build that experience before you try to eat an elephant in one sitting. You know what I mean?
Yeah, absolutely. Experiment with your friends and family. And, once you've proven it with them, then take another little baby step and get some investors. And then once you're ready for, then you have some history to share, or partner with somebody, right, who has the experience. But even that, lately we've been getting a lot of these deals that we've seen that have 7 or 8 GPs. And that also, then I have all kinds of questions about that. I don't want to be somebody's training ground, but also you want to give a new person a chance. But I'm not interested in something that has 8 different GPs that, all have different roles. I don't know who's in charge. I don't know who to talk to, so there's a balance there, I think.
Well, I just want to clarify for our listenership out there, GP stands for general partner on that, where you have a variety of different partners on that. And it almost comes to the point where you have too many chiefs, not enough Indians. You got enough, too many chefs and not enough cooks taking care of things, right? And whenever you're looking at syndication, there should be a clearly defined breakdown of who's handling what, right?
Yes, absolutely.
For things, and the more diluted it is, it can be a red flag. But you also don't want to have where it's just one person trying to do everything as well. It works both ways, right, Jim?
Yeah, it sure does. And if it's one person, like we had one syndicator who was, one of our community's favorite syndicators, and it was just him. And he struggled with communication and some other things. And we had conversations with him because we've invested quite a bit with him. And we said, look, you need some more people. And he was on it. He's like, you're right, I do. And since then he's expanded his staff. He's got more people, and he's still one general partner, but he has a staff of people. He has an investment relations person. He has a CP, he's got all those functions filled. So you really have to look at the team. And if you don't understand the structure of the team, or they can't or won't explain it to you, move on. There are so many syndicators out there. There's a ton of quality syndicators. You got to find the ones that are right for you. And if you're feeling a little bit uncomfortable, there's really no reason to move forward. You just move to the next one, or or find a way to get comfortable.
Yeah. One of my favorites, I think you've had her on your podcast in the past, same here as our friend, Kathy Vetke, does a great job. She's just a phenomenal real estate mind as well, too, in a variety of things out there. Right.
Yeah. She knows her stuff for sure.
Yeah, it's a good one to model after for anybody looking to do stuff. And Kathy is just one of the most giving of people when it comes to information and building a community. Now, you've done something really cool. And this is one thing that I really loved about it. I want to bring it up because I think not enough people did this. Talk about how when you left and everything, and 2 years ago, you started a community. You started building, hey, let's bring people together locally and try to get, row in the same direction, bring like-minded people together. Talk about that and how a monkey wrench got thrown into your plans.
Yeah, well, it did. Yeah, sure. So when I was an active investor, I started a community where we'd meet and have dinner, and that grew pretty big. But once I decided I was going passive, I didn't really have a use for that anymore. So I passed that off and decided, you know what, I need people to talk to who are doing the same thing as me. So
Right.
I started a group, and it was going to be 12 people in Columbus, Ohio. We're going to go once a month out to dinner. And it was going to be 12 because that's the only private room I could find that was free in Columbus. And our first meeting was going to be March 18th, 2020. And depending on where you are, most of us in Ohio, that was shutdown time, right? So the pandemic shut us down, and we decided to have our first meeting on Zoom. And we still haven't gotten together as a group. We've done all our meetings on Zoom. And what it did was it allowed more people to join us, because I had former financial advising colleague or clients, friends, people out of town that were interested in this. And so it slowly grew. We purposely kept it small because we wanted kind of like the mastermind thing. But then we realized if we're doing it on Zoom and we have 20 people, syndicators, other industry people will come to our meetings because they don't have to fly anywhere, right? And so we started having meetings, and the group started to grow. And we kind of had people who were super into it, and then people that were just kind of watching the meetings. And so we started developing investing tools and sponsor evaluation tools and all this stuff. And then it just kind of grew. Then we needed a website. Then we needed membership because we were spending all this money on a website and tools, and we didn't have any revenue. So, we charge for our membership group. It's just covering our costs. We're not looking to get rich here. We're looking to build wealth through investing, not from our members. But it grew into this community. I mean, it's crazy how big it's grown. And really the best part and the craziest part to me is the quality of people that we have in our group. We have people that aren't in their first deal yet and are trying to get into it. And we have people that are in 80 deals, right? That have been doing it for a long time, and they all share and interact. We have a forum that people talk about or talk in, and all topics are open in there. And then we have meetings and all that. And we also have monthly meetings in our non-paid for group, just the Leftfield investors. But really, I think to be successful in this kind of thing, a community is key. It doesn't have to be Leftfield investors. Any community that helps you, that you can talk about. Because I remember distinctly, Steve Sue is one of the founders of Leftfield Investors with me. And the first time I talked to him, we were talking about syndications. And he said, yeah, I'm in a couple of deals. And I said, oh, who's the syndicator? And he told me, I'm like, oh man, I'm in that one too. And then he told me the deal. And I said, oh, I'm in that one. And the sense of relief, like I finally found somebody, a smart guy. He's a doctor. He's in not only the same syndicator as me, but the same deal. And it made me think, okay, I'm not crazy. I just wired someone 25 grand. It didn't go into the abyss. This is going to work. And it just gives you confidence. And the more people that you join up with and you find they're doing the same thing, but maybe they have a twist on it. Maybe they have a better idea. Like someone said to me, hey, I don't invest in a second deal with a sponsor until it's gone one full year. And I thought that's brilliant, because what I've done is as soon as I meet a sponsor, I'm all in and I'm in 5 deals. But it's just wait a year, right? Be patient. It's not a get rich quick scheme. It's a get rich slowly scheme. And so be patient. And then after a year, I reassess and I might invest more. So that's this kind of thing I learned from my community. I also learned that from the community, where I'm not going to invest in somebody unless they're referred to me. Now I make exceptions to that, but that's what I try to stick by. And I learned that through my community. So here I started this community thinking I'm going to share my knowledge with everybody. And I'm the winner, right? I've learned more than anybody in my group. And now we're trying to be a better network and have everybody learn from each other.
The master has become the student in a lot of cases.
Yeah, exactly. Yeah, absolutely.
I love it. But that's so needed these days. And I don't think enough people take advantage of it. And it's gotten, I hate to say this, but COVID with Zoom and other things out there and Facebook groups, I think Facebook groups are the only thing valuable of Facebook anymore these days with the craziness of, but the community, so many people, we've been so locked down and we don't have that breaking bread, cup of coffee, having a cocktail a lot of times in different areas for the last 18 months. It's starting to open back up. Hopefully it stays open up. Every state and city is a little bit different.
Yeah.
but it's such a great way to learn and network. And I love the dinner aspect of it, but if you can't do that, then do this. I mean, we've been doing a webinar every Monday night for like 10 years, 10, 11 years now, as our community getting together and sharing a topic. But it's such a valuable come together, especially for those that are dealing with stress or still working full-time job. It's a great way to really tap into and make sure you're investing passively, doing something versus nothing, right?
Yeah, absolutely. I mean, this is accessible to everyone, but the problem is people don't know about it.
Right.
Right. And so how do you get that message out? Everyone knows about the stock market, mutual funds, because Wall Street pushes it and you hear about it on the news, but no one hears about syndications because it's not exciting. I can't tell you the value of the syndication that I invested in 2 years ago because it's impossible to value. Right. So there's no discussion you can have on the news like, oh, Jim's got a great syndication. It's valued the same as it was 2 years ago. Well, it's not, but I don't know how to value it. So, what we're trying to do at Leftfield Investors is just get the word out, spread the word like you can do this. And so we also get brand new people who maybe they don't have $25,000 to invest in the syndication, but we do group investing through a company called TribeVest. Yep. That allows, 10 people to get together. And instead of putting 25 grand into one deal, you put 2,500 each. And now you're a real estate investor. And these are people who might not have invested in any real estate outside of their own home. And now they're in a deal. So now they can learn and grow and watch how it works, right? And then maybe they start another group of their own, or maybe they go in on their own and invest because, plenty of people are putting $2,000 a month into a 401k, right? And that ends up being about 25 grand a year, right? But not very many. When you say, hey, you need 25 grand to get in one deal, people are, oh my gosh, I don't have $25,000. Okay, you do, you just don't know where it is.
Exactly.
So that's part of it, right? I want this to be, I'm pretty passionate about spreading the word and getting more people into this because it works. And I think it works better than just throwing your money in a 401k. I really do.
Well, that's the thing is, you usually get great returns from syndications. If the person, the sponsor is doing a great job with it, knows what they're doing. You've been down that road of doing stuff yourself. Now, are you still doing, I think I read somewhere where you're still doing some hard money lending. You're helping some people with investing some funds via hard money. Still doing that, Jim?
Yeah. So I do private lending, only with a very few select people that I really know, because I don't know active investing anymore. And so someone will send me, hey, I have this deal. And, I know Columbus, but let's say it's in Columbus and they say, here's the price. I'm like, I don't do that anymore. I have no idea how to evaluate it. So the people that I used to go to evaluate these deals are now the people that I'm lending to. So I have confidence in those deals because they're bringing them to me, and they're deals that, like I said, I would have them evaluate them, and I trust them, and I get personal guarantees on the loans, and it's just easy. So I just kind of recycle it through. And most of the time now, as soon as the deal closes, they say, hey, can I just pay you the interest and roll the capital into the next deal? Sure. So my capital never stops working, and it's great.
That's a beautiful thing there. Velocity of capital. I heard you mention somewhere about how you're looking for that cash flow. That's one of the most important things out there versus appreciation. And we all know that there's different depending on the market, especially California investors are often just betting on the appreciation on the cash flow. Yeah. Well, people would slice their grandmother's throat for a 3 cap. You know what I mean? That 3 cap does not excite me at all. You know what I mean?
Right.
Let's talk about that philosophy and why you have that philosophy of, hey, I need cash flow. I don't need appreciation.
Yeah. Well, part of it for me is I'm a full-time passive investor. So if I don't have cash flow, the family doesn't eat. I mean, it's not that severe, but we need cash flow. But really, most of these assets are going to appreciate, right? Most of these assets, they're forcing appreciation, meaning the syndicator is going in there and they're making improvements and they're increasing rent. So the appreciation is going to be there, but I look at it as a bonus. What I want an asset that produces cash now, and the cash is going to increase as the asset continues to improve. But the cash that I get now is the 8 to 10%, and it's basically tax-free if you do it right, which is better than you're going to get in the stock market. And that's good enough for me. And then after 3, 5, 7 years, whatever, you're going to get this bonus kicker of another 50 to 100% increase in the value of your asset. So that's in the back of my mind, but I need to invest for cash flow now because that's what propels my lifestyle and everything else. So it just keeps growing, right? And it's a snowball. Once you get into these, they just snowball, because as soon as you go through one deal and it goes full cycle, you do the next one, and now you have twice as much. And so your cash flow doubles. And so everything keeps accumulating, and it just grows and grows.
Mm-hmm. Yeah. Do you miss any of the operations of doing the deals yourself versus jumping into syndications?
No, I really don't. I mean, there's some of that, where it's exciting because you're in there doing the work or directing someone to do the work, and then you get to see the results. But, so much of that for me was out of my comfort zone. I didn't know what I was doing. I was managing a manager, and it wasn't for me. This passive stuff is for me, because now I'm picking I think someone used the analogy, you pick a jockey rather than a horse, right? Yeah. So now I'm just picking jockeys, and they manage the property manager. They are professional asset managers. That is their job. And so I hire them to manage my part of the asset, and I expect, them to pay a return, and they're professionals. I was not a professional asset manager. I was a guy trying to tell a property manager what to do. And the property manager, they would agree, they would disagree, and they would just end up doing what they wanted anyway.
Right.
So yeah, I don't miss it. Where I get the excitement is on the side. I do some speculation stuff, Bitcoin, pre-IPOs. That's the fun stuff. The real estate is exciting because that's where you make money. And it's, like I said, a get rich slow scheme, I guess. But the speculation, the other stuff is where you get a little bit of the excitement, and you kind of cross your fingers and hope.
Well, the speculation stuff is exactly that's the speculation. You're investing in those things with money that if you lose it, you're okay losing it because it is speculating. I mean, you don't want to lose it, obviously, but if you do, it's not going to affect the bottom line for the most part. Whereas the true investment and stuff, you should never invest in anything you don't end up, can't lose or live without in a lot of cases.
Right. And
just because the deal doesn't go plan A, there's often plan B, C, and D. And that's a beautiful thing about real estate too.
Yeah, that's a great point, because I've finally figured out after all these years that there's investing and there's speculation. And in my mind, if it's not paying you to own that asset, it's speculation. Mm-hmm. That's the stock market, right? Because as I've said before, if Apple is having the best year they've ever had, but the stock market tanks, Apple stock's going down, not up, right? But if you're on in a multifamily syndication and that asset performs great and the market tanks, you're probably still going to be okay because your asset is doing fine, right? It's not affected as much by the market. And so you got to figure out where are you investing and where are you speculating? And once I kind of figured that out, it opened up a whole lot for me, because now 90% of what I do is investing in assets that produce money that produce cash. I'm not just the stock market. You're waiting, you buy something, you're waiting and hoping you can sell it to somebody else for more, right? Before it tanks. Where if you're in real estate, you're buying an asset, you're managing somebody, or the manager's making improvements to that asset that is going to increase the value while you're getting cash flow. They're increasing the value, and then they're going to sell it, but they've increased the value. So it doesn't matter as much what the market is doing because you've already increased the value. So it just makes sense to me now.
Well, that's the thing is real estate. It is a longer term play. It is not a get rich. It's a 3 to 5 year process per asset, especially syndications. And then for some real estate, it's longer than that process. And you don't mind if there's a dip because it's going to come back. And if it goes up, you can't always plan on, you try to sell it at the peak, but if it doesn't, okay, let's hold on to it for a while, as long as it's cash flow, as long as it's covering what I got to pay each month out. If there is a payment, you're still sitting there. And I think so many investors, they get stuck on one tactic or one tool. And then when things go awry, they flip out and they end up losing money because they're reactive versus saying, hey, let's step back and look at the backup plans. You know what I mean?
Yeah. And I think that is a crucial point that you just made, right? Is that there are multiple strategies. So when I invest in a syndication, they say, hey, we hope to refinance and give you some of your capital back within 3 years. We also hope that we're going to sell the asset in 5 years. And then I ask them, okay, what if the market changes? What happens if you can't? Well, they have a plan, right? Well, then we're just going to cash flow for 10 years until we can sell. And that's great. But if you're investing in, again, I compare everything, I guess, to the stock market, there's no other strategy, right? You're hoping that the market continues to go up and you're hoping you sell at the right time, but there's no backup plan. If the market tanks, you tanked. So that's what I like about real estate is even though I'm passive and it's not under my control, it is under the control of the person I selected to manage my asset. So they're controlling it. I put my faith and trust in them, and they can, as you said, change plans. If we can't refinance because the market just won't have it, fine, let's cash flow for another 3 or 4 years. All right, you're going to keep paying me 8 or 10%. That's fine. I can live with that. That's what I got here for, it just saves me from having to go find a new investment because you gave me my capital back.
Right. Which then is sitting in an account, not making anything until you can get in something fast. Right.
Right. So there's just multiple exits, and that's what I like.
As an ex-financial advisor, how much do you, especially in your group, how much, and for new investment, how much are you recommending people to use a self-directed IRA or self-directed accounts? Is that a priority for a lot of folks in your group?
It is sometimes. So I think with the IRAs and the self-directeds, I recommend that people do notes or any of those the real estate related but non-tax advantaged things, right? Because of the taxes, you're not paying taxes in those accounts. So I have a self-directed 401k, and I do my private lending out of that. I invest in a few note funds out of that. That's where I try to do that. So we do talk about that a lot. And if I didn't have any other money and I wanted to invest in a syndication, I might invest out of my 401k, but I'd much rather go to a note fund that's paying 8 or 9%, because it's just easier and I don't lose out on those tax advantages. So we do have a lot of people that are in self-directed IRAs, and we do kind of encourage them, hey, look at the note space of private lending or things like that, because I think that's a lot more effective use of the tax code.
Yeah. Well, who knows what the tax code's going to be?
True. That is true. It's always changing, but you know what? There's always going to be advantages that they put in there for real estate investors, because most of Congress, they own real estate, right? So they want to keep they call it loopholes, but it's really just instructions. Yep. It's just instructions on where the government wants you to invest, and it seems like they like real estate, so that's where I am.
Exactly. Just follow the code. They'll give you all the answers. It may be
exactly
in small font where you can't find it sometimes, but that's the most important thing about surrounding yourself with like-minded individuals, professionals, attorneys, accountants, people that know what the heck they're doing, and people that are in multiple deals or have an experience, because then you'll learn about things that most people don't ever know about.
Right.
It's word of mouth advertising in a lot of cases, right?
Yeah. And it's true. As a financial advisor, we talked all the time about the biggest eroder of your wealth is taxes. You need to master the taxes, but not once did we say, hey, real estate's a great place to do that. Right. It was always these crazy schemes and ideas. And, I think a lot of times people go into this super complicated, Delaware statutory trust, 1031s and all this crazy stuff to avoid taxes. And, when I went to my accountant after I was selling all the multifamily properties and said, hey, I got some big capital gains. And I said, what am I going to do? Should I do a 1031? Should I do a qualified opportunity zone? He said 2 things. First thing he said is, Jim, sometimes when you make a bunch of money, you're just going to have to pay taxes.
Right.
And then he said, but if you don't want to pay taxes, you could do a lazy 1031. And the lazy 1031 basically is, I just invested in syndications, and the paper losses I got from cost segregation, bonus depreciation, wiped out or deferred or offset all of the capital gains I had from my other investments. So there are ways to do it. You just have to know how it's done.
Mm-hmm. Well, that's the truth is there's ways to do it. Talk with professionals. Most people don't ever talk to the professionals. They just go the cheap route. Well, the cheap route ends up becoming very expensive in a lot of cases, right?
That is such a good point. I finally realized that it's worth paying my accountant $250 to talk to him for an hour about strategy. It's worth it to pay my attorney $200 an hour to talk to him about strategy, or $600 to do a set of documents. So I'm not using something that some guy drew up on a napkin. It's worth it. They are professionals, and you pay them, and it hurts when you pay them. But you know what? A couple $100 doesn't really matter if you're making thousands. But if you don't spend that and you lose thousands, you're going to wish you could pay that couple $100. So I believe in paying those professionals. It still hurts. I still try to negotiate with them, but you got to use them because they're going to protect you.
Mm-hmm. A question for you. This is kind of, if you look back now, the last 5, or actually, let's go back to 2008. We're seeing a lot of opportunity, I think, coming down the board. I mean, we're having conversations with banks and seeing defaulted and distressed debt. How are you approaching the next market phase differently than what you've done the last 13 years? What are some of your, I mean, besides syndications, are you doing anything else to take advantage of different opportunities?
That's a great question. I am just trying to communicate with as many people as I can and learn what they know, right? So I'm just kind of keeping my ears out. I have capital. I am not going to sit on the sidelines and watch it erode to inflation. So I am still going to invest in cash flowing assets, because I believe that even if the market, whatever market you're talking about, drops, if your assets are cash flowing, they might cash flow less, but they're going to still cash flow. So real assets is the place to be. Now, I know there's going to be some opportunities in, once the moratorium's in, and there can be more foreclosures. So I'm certainly looking into that space. That's not my expertise, but that's why I'm talking to people like you, so that I'll be ready when that happens to call you up and say, hey, Scott, you got any deals? Let me get in some. And so that, I think that's how you prepare, is you just kind of keep the pulse of the markets, but also talk to the experts in different things. I don't know that I'm an expert in anything except, my community maybe, but I'm talking to a lot of different people who know a lot of stuff, and I'm, hitching my wagon to their train.
How's this is an off the wall question. This is a left field question. Okay.
Excellent.
Quality of life, thinking back to being a financial advisor to where you're at today. What's the thing that stands out the most as far as quality of life? Or let's not talk real estate. We know real estate's help finance it, but let's talk about how the difference in your day-to-day or your family, how's that been a big impacted?
Well, it's night and day, right? As a financial advisor, I was in charge of my own business. I was managing my own business. So if I wanted to take 2 weeks off, I could take 2 weeks off. It's the same now. But the difference is I'm not trying to convince anybody of anything. Right? I would meet with clients all the time, and I knew I could help them. I knew I had, even though I'm talking bad about the market and stuff, I knew there were solutions that I could give them that would actually help them. And I had to convince them because they didn't believe me, or they didn't trust me, or I didn't explain it good enough, or whatever it was. Now I don't do that at all. I present things to people. I try to help people, but if they're not interested, it doesn't matter. Right? I don't care, because I know that I'm still making money on the investments I'm doing. So I feel like I've been an educator my whole career, right? My whole life. I was even a teacher for a while, but now I'm still educating people. But you know what? If you're not willing to learn, or you don't want to learn, then I'm not talking to you, because you're not joining my community, right? And it's not that I wouldn't try to help somebody, but I don't have to try to convince people now. And I think that's such a huge difference, that I got really frustrated as a financial advisor, knowing that I could help people, but I wasn't able to, because either I wasn't doing something right, or I wasn't convincing them right, or I wasn't educating them right. But now I have a lot more confidence, because I feel better about what I'm doing, because all of the stuff is going to help people. But also I'm to the point where if you want help, I'll give you time. But if you don't, I'm going to move on. I'm not trying to convince anybody of anything. And that's a huge difference. And it's a lot less stress.
That right there is definitely one of the most important things. You're not trying to bang your head against a wall, trying to get somebody to understand that you're trying to help them.
Right.
Versus people are coming to you versus you trying to go to people in a lot of cases. It's a big difference. Yep. I love, total aspect. Being your own boss is great and stuff like that, but it's also the whole aspect of that mentality adds a lot of being able to sleep at night, but also being able to do a lot more fun, not being stressed out around the family and doing some other things, right?
Yeah. And, I felt a lot of pressure to help people back then, and pressure to, produce and earn a living also. Now, the only pressure I feel is I want to make sure I'm giving our community the best information, the best network, the best help they can get. I feel pressure there, but it's all people that want to come together and learn. It's the same thing when I was a high school teacher for a while. I was teaching finance. I loved helping those kids, and it was Columbus City schools, and the kids needed help, and I loved helping them. But a lot of them just weren't interested. And I don't blame them. They're high school kids, right? I love teaching people who are thirsty for the knowledge. And I struggle when I have to convince someone that they need to be educated. It just doesn't work, right? You have to want it. So I think I finally found my niche where, I'm happy to share my knowledge, but you gotta bring something. You gotta bring some desire in order to get it. And
Mm.
it's a big change.
Yeah, that definitely, that desire to learn, a desire to better oneself is so important. And it's what's still great. It's one of the great things about this country is we have the opportunities to do that no matter where you're at and what you were born with or what you're born without in a lot of cases. Yeah.
Absolutely.
Good as to you, man. Well, Jim, what's the best way for folks to find out more about you, connect with you, find more about Leftfield Investors in your group?
Yeah, there's two ways. You can go to www.leftfieldinvestors.com. If you want to subscribe to our newsletter, there's a button up there. You can do that. Or if you just want to contact me directly, you can email me at jim@leftfieldinvestors.com. I spend a lot of time just talking to people, and I'm happy to talk and explain our group and see if it's a fit for you. Like I said before, if you're interested in passive investing, I highly recommend finding a community that fits you. Leftfield Investors is not a fit for everybody, but we're a fit for some people. And if we're not a fit for you, go somewhere else and find a community, because I guarantee you it will take your investing and your success to a whole new level.
Amen to that, brother. Love it, love it, love it. Jim, it's been an honor to have you on the podcast and share your story, the journey, and great to see some mutual thoughts out there with everything going on there. You don't have to be the expert at everything.
Absolutely.
Go find the experts and invest in those people. And I love that out there as well. So thanks for coming on the podcast today, Jim.
Thank you. It's been fun.